Good afternoon, everyone. Hi, it's Brian Hartstein, and I'm here with one of my partners, Andrew Raffel, who's actually the founder of Bayntree Wealth Advisors. We want to welcome you to the fourth quarter 401k educational webinar during this holiday season, and we're trying to start right on time because we know everybody here is busy with the holidays. But what's interesting is the topic that we had planned for tax reform and Social Security happens to be a very, very timely topic with tax reform slated to be voted upon this week. So we had already planned on it, but the timing just ended to work out perfectly. So we're glad everybody could join us. I'm glad that you could take some time out of your day to listen to the information that we're going to provide. And if you know people who can't be on the webinar, we will provide a recording of this to the HR department, so hopefully they can obtain the information by listening to the recording as well after we're done today. So I just wanted to, again, introduce you real quickly to the Bayntree team here that's dedicated to help servicing your 401k plan. That's myself, Chris Roger, who's our financial advisor who's dedicated to helping support you with any questions, whether it's financial planning, investment, risk, portfolio structure, or anything having to do with your 401k account or anything that builds around your 401k account from a family planning standpoint. Please feel free to reach out to us and ask any question whatsoever. We're here to support you. And Rena Blanco is probably your main point person, either her or Megan Shy. You'll probably talk to if you do call our office, and they'll get you to the right person to hopefully get your questions answered and the support that you need in terms of whatever those questions are. So, but I'd like to just jump in real quick and introduce Andrew Raffel, again, one of my partners who this is one of his specialties and areas of expertise is on the Social Security side. So we do get a lot of questions from not only from older participants in the 401k plans, but also from younger ones who maybe don't understand how Social Security works or how their benefits are calculated. So we just thought it'd be a really good topic to try to tackle along with tax reform. And so I'm going to turn it right over to Andrew. So,
all right. Thanks, Brian. And thank you all for joining us today. From our standpoint, building a plan is important to look at putting all the pieces together. And as you're working and building and accumulating assets, the whole goal in retirement is to have income. And one thing we're very passionate on is understanding one of the cornerstones of an income plan in retirement, which is optimizing and utilizing Social Security. Too many people don't really look at how Social Security can be utilized, and they make quick decisions. So one thing that we're passionate on is explaining and teaching how Social Security can be used today. Look at, we're going to kind of talk high level on some things. We do a lot of workshops throughout the year in regards to teaching how Social Security fits in. So a couple of things first on a disclosure note, Bayntree is not affiliated with the U.S. government. Do not take anything we talk about today as advice. Make sure that you talk with a licensed advisor, CPA, et cetera, before you make any decisions. But as Brian had mentioned, the goal with Bayntree is helping each and every one of our clients put together the pieces so they have a cohesive plan. And, one area with Social Security, if you think about the average couple in their mid-60s that have worked, they have paid into the system between Social Security and Medicare over $500,000. Now, I don't know about you guys, but that's a lot of money. And so we want to look at how to use Social Security as an asset and to use it properly. Now, a couple of things that have happened in the last few years that some of you may be aware of is that back in 2015, the government actually threw in the bipartisan budget bill, something that took us all by surprise, but they took away several of the creative strategies that we use to help individuals and families maximize their Social Security. We're going to go through those quickly, but the main one that they took away was the file and suspend strategy and the restricted application for spousal benefits, or we used to call it the free spousal benefit. And, when you think about that, they took that away because not that it was, not good for you, it was ultimately a way for us to look at how the laws were set up and making sure that we maximized it. So the way it used to be is people could file and suspend and then continue to grow their benefit to age 70. And by doing that, it allowed a spouse to file a restricted spousal application. So back in 15, the law went into effect. In April of 16, no more file and suspend. No more retroactive lump sums. So these are all things that the government did as a means to help maintain the the funding of Social Security. So when they took these things away, we look at it, it is a negative, but it's also a positive in a means to make sure that Social Security will be there for all of us. And then ultimately, if you did file early, it's going to be deemed filing before your full retirement. So these timelines, though, very important. File and suspend. Anybody after April 30th of 2016, it no longer exists. So we did have a big push last year to help people understand that they can still file and suspend, but from here on out, it is not going to be part of an overall plan. So kind of put that out of your mind because there's nothing we can do there. The restricted spousal application, this is very important. For those of you that turned 62 by the end of 2015, they did create a clause, they grandfathered it in. So those of you that are over that threshold, there are still some creative ways that we can use Social Security. So that's why it's so important to understand how it could affect you and the different types of ways that you can use Social Security. Because when we think about it, in retirement, there used to be, kind of think of it as a three-legged stool. And many people in the 50s, 60s, and 70s relied on a company pension. Well, as all of us know, it's moved more from the defined pension plan to the defined contribution plan, which all of you have, is to, put money into the 401k. That risk now is on you to save and to invest it wisely and then to use it as income. A lot of people use annuities to create income, whether it be for a certain period of time or for guarantees for the rest of their life. And then most importantly, Social Security, how that can fit in, especially with some of the loss of pensions that we've seen. So we want to look at not only the assets you've accumulated, but utilizing that in conjunction with Social Security, because when you think about your IRAs, your 401ks, tax-exempt securities, taxable securities, we ultimately don't have in those guarantees. So based on how you're positioned or how much risk you're taking or how much risk you're not taking or what the market does, the variable income could be where you fall into some trouble. So that's why we want to think of the foundation of income, the foundation of your fiscal house. We want to protect it. And if you're not fortunate enough to have pensions, that's where you want to look in how can Social Security be an effective way for you to generate. For some people, it's 30% of the income they need in retirement. For some, it's a lot more. And we'll go through some features that Social Security has where it makes it a very, very, asset class that we look at as very beneficial because it has some inflation attached to it. It has some tax benefits as well. This was a report back in 2011 by the GAO, the Government Accounting Office, ultimately trying to ensure that individuals and families have income throughout retirement. And what you'll notice is obviously understanding how to systematically draw down your savings. For some, it makes sense to utilize guarantees like an income annuity. And one of the big things, and this is from our standpoint, we really look at, is there a way to maximize or delay Social Security? And that was one thing, if you look through report after report, most of those reports will come in and say, if you can delay your Social Security and hedge your longevity risk, you're going to be better over the long term. I know many of you are thinking, well, you know what, right when I turn 62 or when I turn 66, I want what's rightfully mine. And I get that, but you really have to understand what that's going to do and how that's going to affect you over the long haul. So part of what we do at Bayntree, and for each of you as individuals that have 401k plans that we're helping you with, is that we're going to go through a customized report that we'll give you access to at the end. So you can really understand, if you take it early versus waiting, what's the break-even point and what's going to be the best way for you to position it based on your situation. It's not a one-size-fits-all. And then what we're seeing, Brian, is, a lot of people are having to work well into their 60s and their 70s because they didn't save or because they made bad decisions. And those are all things, if you plan correctly, that we can help make sure that you retire at the time that you want to. When we look at Social Security, people are living longer. And, I had a grandmother that was 1 month away from turning 103. We all know family that are living into their 90s, friends that are into their 100s. So one factor you have to look at is, how is your health? We can never predict, but when we look at longevity and we look at healthcare costs, those are two critical pieces that we can't control. We may live a long, healthy life. The key is, are you going to have the money to make sure that you don't outlive not just your savings, but we look at it as we don't want to outlive our lifestyle. And so factors, when we look at Social Security, it's based on when you started working, and it's really, when we look at it, the simplified version is it's based on your top 35 working years. So those years in the beginning when you were working versus towards the end of your career when you were making more money, all of those factors are built in, and also it's going to be based on when you decide to collect. So those two things, and that's where we want to look at the whole picture. We can't just blanket out and say, turn it on now. We need to look at where you are, what other assets you have, what type of longevity risk, how old if you're married is your spouse, all those different things that we look at. Now, I know most of you remember getting in the mail your benefit statement. The government used to send this out every single year. It was white with green, and you got it. Most of you remember that, but the key is they haven't really sent that out in over, I think, Brian, 5, 6, 7 years now. And by doing that, it saved the government like $80 million a year. So the big push, and if you haven't done this, we recommend that you go create a unique user ID and password on the Social Security website. You can see the domain here. You can also just Google Social Security, and then what you'll do is you'll go and you'll create a username and password. They'll ask you some security questions, but what that will do is it will allow you to see your report in real time. And there's a couple of reasons why you want to do that. Number one, you want to make sure that the information that the Social Security Department has on your work income is accurate. Many times, Brian and I will see with clients that the report itself doesn't have income that they earned, and if it's less than what you actually pay taxes on, that's going to affect you. So we want to always make sure that those numbers there, it's not always accurate. Number two, it also shows you what your current benefits will be at 62, and then at full retirement. And for some of you, full retirement is 66, and for those of you that are a little bit younger, it's 67. And it also shows what your benefit would be at age 70. So these are all things that we need to help you put together a report to see when it may be optimal to take Social Security. So if you have any questions with that, you can always reach out to our office. We can guide you through it. And if you have problems with that, you can also go to the Social Security office. Now, in regards to full retirement, it's defined as FRA, your full retirement age. Those of you that were born between 43 and 54, 66 is the full retirement age. That's an important age. A couple things that we'll go through, but it has to do with maximizing your benefit. But also, if you are working, there's something called the earnings limit that will go away once you turn 66. And we'll touch on that a little bit. And then as you can see, for those of us that were born in years after 54 and those that are born 60 and later, the full retirement age is 67. And one thing that I think is going to continue happening is that to continue to fund the system, the government's going to continue pushing back that full retirement age from 67 to 68. That's one way that they can reduce the amount of benefits they pay. Another way will be the tax on Social Security, which right now they've increased it each year of how much of your income until it maximizes. And right now, I think, Brian, it's just under $130,000. So that's another way that they can continue having money coming in to help fund the system. Now, when we look out at taking early versus waiting till retirement, full retirement age versus waiting till age 70, one of the things is by taking early, and you can see here somebody who's 66, full retirement age, if their benefit was $1,000 and they took their benefit at 62, forever they're going to have a 25% reduction. And when you think about that over the long haul, and we can run the numbers with the report, but that becomes a huge amount of money that's lost. Obviously, every situation is a little bit different. If you need to file early, those are things depending upon your work, income, as well as how much assets you've accumulated. The longer you wait, the bigger the benefit will be, which we'll touch on, and that's something that's important, not just for you, but Social Security is also going to be utilized if something does happen to you and you're married. The higher earner or the higher income amount from Social Security will pass down to the spouse. So that's why it's very, very important if we can maximize the higher earner as a hedge against the longevity of both a husband and a wife or partners. Now, one thing as we look at, and you've probably heard this term before, the longer you wait, your benefit increases at an 8% rate, all the way up into the max, which is at this point age 70. And that's where we look at today in low interest rate environments. You think about the bank paying you 0.5%, a CD at 1%, low interest rates. There's nowhere that's guaranteeing you an increase at 8%. So that's why we don't want to take this lightly. We want to really look at all the different situations that are out there, and is there a way to bridge the gap so that you can make sure that you maximize that 8%. And then this will go through, again, by taking it early versus waiting, the difference in how much benefit you get. So this FRA age or full retirement age, each year, each month, whenever you do file, there's a reduced amount, and the earliest you can turn it on is 62. There are some other, different types of benefits that if there's a survivor benefit, you can do it a little bit earlier. And then the max is to age 70. So these are all critical pieces. Now, if you do take your benefit early, and that's before your full retirement age, there's something called a clawback. And what this means is every dollar that you earn over, in this case, just under $17,000, you're going to get one out of every $2 of your benefit pulled back. So you think about this. If somebody files at age 62 and they're making $60,000 a year, number one, they forever have reduced their benefit because they filed early. But number two, they're not going to receive any benefit because they are well over that threshold. So for that situation, it's almost a no-brainer not to collect. As you get into your full retirement age year, let's say your birthday is October and you're going to turn 66 in October, you can actually make that year as much as $44,880 before they claw back one out of every three. So it does give you some provisions in there that you can make a little bit more money in the year that you do turn 66, especially if your birthday's towards the end of the year. Once you reach full retirement, then you can earn as much as you want, and your benefit will not get reduced. So these are all very important things to think about. And then another area where we're not going to dig in too deep today, but one of the ways we like Social Security, we can maximize it, but it's also taxed a little bit differently than money you pull out of a 401k, of an IRA, work income. Basically, the max that you can get taxed on is up to 85% of your Social Security. For some people, they don't pay any taxes on their Social Security. So these are all things that we look at to say, well, can we bridge the gap, continue to grow Social because it's taxed more efficiently, and pull out from other buckets until maybe that age 70. So those are all things that we help our clients understand how taxes fit in. The reports that we build will show that as well. So these are areas where we look at Social Security as a very valuable asset, and it's taxed much differently than other retirement assets. Another factor of why we like Social Security is that historically it's had a cost of living adjustment. Now, I know for the last 5-6 years since the Great Recession of '08, you can see that we haven't had much of a means of increase. This year or into 2018, it's going to be a 2.1% increase, and historically it's been 2.5%. So that's something when you think about your benefit, not only are you having it taxed more efficiently, but then you also get the inflation attached to it as well. All factors that a lot of times when you have pensions and other income, they don't have that cost of living. So, when we think of Social Security, there's hundreds of ways in which you can file. You can file early, you can file late, you can file at full retirement, you can potentially file on a spouse's record, file and suspend. Used to be part of our workshops, but no more. Also, you can, in some cases, do a do-over, which we can go through in a little bit more detail. Those of you that were married for more than 10 years and divorced and not remarried, there is a way that you could file on your spouse's record. And then there's also survivorship benefits. Survivorship benefits are ones where if you did lose a spouse, you can actually claim their benefit and potentially continue growing your benefit to age 70. A lot of people don't know this. Social Security office are not trained to give you advice. If you say one wrong word, they are going to give you that advice based on what you told them. Or not advice, but they're going to follow that mandate. So that's important. Don't count on them giving you the right advice. Talk to a trusted advisor, a professional, somebody who knows this space. And that's one of the things that we're going to be able to offer to you guys is the ability. This is as no cost, is the personalized Social Security report. And we'll give you a way in which you can contact our office to get this. And what this is going to do is, based on your situation, it's going to provide an opportune time based on, how long you're going to live, what would be the break-even point of filing early, filing at full retirement, filing late, and it really helps us understand how things fit in. So that's a critical piece of a retirement plan that we'll be more than happy to go through with you. And ultimately, the longer we wait, the better it is. If we know when we're going to pass away, our job is really easy. Your job would be really easy, but we have to plan that you're going to live a long time, and this is a great way to hedge against that longevity risk, the healthcare risk, et cetera. So the one thing to take today, I know we went through a lot very quickly, is don't make a rash decision. Look at all aspects of how social is going to fit into your overall retirement plan. We call it our Bayntree Retirement Blueprint. And that's where we look at social as a very big piece of that puzzle. No matter how much assets you've accumulated, you've worked hard, you've put money into the system, let's make sure that you maximize for you and for your spouse and potentially even your children, that you're not making bad mistakes. Because once you make a mistake, Brian, it's how difficult it is to go back. So hopefully that was helpful. At the end, we'll go through how you can contact the office to get a customized Social Security report that's going to be right for you. And then the last thing today that we're going to go through, and this is very top of mind for everybody, and ultimately it hasn't passed yet.
Not yet.
By the time we finish this, it may pass. No, but
well, we're not sure what version.
So, from that standpoint, we're getting a lot of calls. How's this going to affect me? What's it going to do? And the one thing we have to look at and say, okay, here's where the plan between the House and the Senate, this is what they compromised on, at least right now. But as of today, nothing is set in stone. But we know something is going to be passed. Once that happens, again, Bayntree will be here to work with you and your licensed tax advisor, CPA. We can give you advice. So some of the main things that we're going to look at of what they're trying to do, and in a sense, Brian, they're trying to simplify things, right? Simplifying it in theory, yes, but I think it's going to actually make it just as complicated as it is.
Well, I always say that when the government's involved, usually nothing is simple, even if they say it's simple. So it's going to shift kind of from one area to another. So in their eyes, it might be simpler. For us, it's not going to be any more simple or complex. It's just going to change what we can do and how we can do it.
So for the individual taxpayer, those that aren't business owners, that are an employee, they're lowering the tax brackets from 9 to 7, and they are going to lower, for a lot of you, the amount of taxes that you're paying at that higher threshold. Remember, if you're at a 25% tax bracket right now, you're not paying your taxes based on all at 25%. It brackets up from paying 0 to 10 to 15, et cetera. So that's one thing that I think will be a benefit, is that they're lowering the overall tax brackets for everybody, and they're lowering the top rate from 39.6 to 37. One of the things they're trying to do is make it simpler in the context of less itemization. So those of you that itemize your mortgage interest and your health costs and your charitable deductions, well, what they're going to do, as you can see here, is they're doubling almost the standard deduction. So they're going to double that from a single filer, where you have right now $6,500. They're going to double that almost to $12,000, and then for couples, $13,000 to $24,000. So that is going to eliminate, for some of you, the need to do itemization, which should make your tax return a little bit simpler. So that is, let's check that box that says it will be simple. But here's where then they giveth, they taketh away. The personal exemptions that we all have, those are going to be eliminated. So that's something that your exemption, goes away. Your deduction, standard deduction, goes up. Still think it's going to benefit a lot of people.
Well, and for those with multiple dependents, it will also eliminate those as well. So again, they're kind of giving with one hand, they're taking away with the other.
And then, Brian, they're going to add in, increase from here, at least at this standpoint, the child tax credit, which would be $2,000 up to those that some people, families don't pay any taxes at all. So they're going to give them, in a sense, a pure credit of at least $1,400, and then for other dependents as much as $500. So this is one that I still think there may be some changes to it. And it may not affect a lot of you who have kids that are older.
Right, and they're also raising the ceiling to before they start phasing out some of those credits. So you can earn or be a much higher wage earner before some of those get phased out. But as we said before, none of this is written in stone. So we have gotten many calls over the last couple of months, and we always say we're very well aware of what they're talking about. but we won't begin to start planning until we actually know what they've concretely passed. But it's good to have the discussion.
And then in the scope of a lot of you that are Arizona residents, this won't be as major of a factor in regards to deduction of your state taxes, your property taxes. Those that live in California, New York, some of the Connecticut, some of the states that have the highest state income tax, this is going to be a big blow. So basically what the reform says is that you're going to have a maximum of being able to itemize up to $10,000. So for many people in Arizona, because our property and state taxes are low, won't have as major of an impact. But if you're in New York and you've got state taxes and property taxes and local taxes, et cetera, it's going to be a big hit. So that's where you're probably seeing things where it's going to help some, it's going to hurt others. The other thing that they're going to do with regards to mortgage interest is make it a cap of mortgage interest up to $750,000. We had it at $1 million, so it's a change. But for again, Arizona real estate prices aren't like California, so it won't be a major thing, we don't think, for many of you. Estate taxes, again, for the top tier, they're increasing this. They didn't repeal it, but they're going to increase it from right now over $5.6 million for each individual. They're going to double that to about $11.2 million. So that means a couple, husband and wife or partners, can actually exempt up to $22 million or so or more. So if that's an issue for you, then definitely give us a call if it's over that amount. But that would be more advanced type planning. No changes to capital gains. There is going to be some changes to corporations. So again, this may not affect a lot of you guys, but this is one where the whole thinking is if we lower the corporate tax rate from 35% to 21%, then that trickle-down effect of these corporations paying less in taxes means that they're going to have more they're going to have more growth, hire more employees, put more back capital into the business. Hopefully that comes to fruition. We saw that back in the 80s where it's, I don't know if it actually worked out that well, but that's the thinking here, is lower the corporate tax. And that's why you're seeing a lot of the large cap companies in the Dow Jones and the S&P and really just the equity markets over the last month really run up in regards to that, because this is a major benefit to corporations. The key is going to be, Brian, is this money going to go down to Main Street, or is it going to stay within those coffers? And we just don't know. But that's where a lot of this overhaul is in regards to the corporate side. And then there's more stuff that we can go through, but I think this kind of gets into the weeds on some of the corporate versus the income side for the individual.
And again, we don't do tax returns here, but we're very well versed on the tax side, and we work very closely with the accounting community, both here locally and in the Southwest, because we feel it's such an important part of our clients' focus and an important part of their overall planning. So again, we try to stay on top of this. When we finally know what's concrete, we'll do our planning based on that. But if you have any questions, obviously, if you have an accountant or you work with somebody in that, you can certainly rely on them, but you can also ask us any questions, and we'll do our best to help you there.
And so, Bayntree, our focus is helping you. Any questions you have on your 401k, we can look at your asset allocation. We have wonderful technology to run a risk assessment of where you're currently positioned, where we are in this market cycle, and is it appropriate for you? And then can just give you some guidance within the plan of the different funds that are available. Also, as we touched on today and dug deep into Social Security, if you did want us to talk to one of our advisors on how to optimize Social Security and obtain the customized, personalized, free report, what you can do is contact the office, email the office, or you could go to Bayntree.com/askbayntree. On that page, you can simply put in your information, and then we will have one of our licensed advisors give you a call. So Social Security, retirement planning, asset allocation, and your investments, they all go hand in hand. They all mean something differently, but as you build those pieces and you put them together to build the right plan, you can make sure that you're reaching your goals, that you're going to be having that income in retirement, and that you can enjoy that next chapter. So that's what we're here for. It's education. Ultimately, we want to provide you guys the right advice so that you can make sound decisions.
Right. And again, there's no cost for accessing our office to help with those areas of planning or those services. It's part of what we do to help support the 401k plans and the companies that we work with. So again, if you have questions, please feel free to reach out to us. That's what we're here for. So.
Wonderful. We thank you for the time. I know your time is precious, and hopefully this was beneficial. We will have the recording of it being sent out to those of your colleagues and other members that weren't able to participate in today's call.
Yeah, so have a wonderful and safe holiday season, and we look forward to hopefully speaking with you in the future. Thanks and take care.
Thanks, guys.